Continuing on with our look at the 10 Commandments of Investing, the next comes from Richard Russell, author of the Dow Theory Letters. And with regard to dividends, Russell says a stock dividend is something tangible. It's not an earnings projection, it's something solid in hand. A stock dividend is a true return on the investment. Everything else is hope and speculation. Russell is really highlighting the importance of dividends in the overall portfolio and the role that they play in the overall return that an investor receives from investing in equities. If you look at the period from 1910 to 2000, roughly 90 years of investing history, of the 9% average return that investors received from being in equities over that period of time, a full 6.8% came from dividends and from dividend reinvestment in the strategy. It's important when you're looking at companies to look not only at companies that pay a dividend, but at companies that grow their dividends over time. And the fact that a company has the ability to generate free cash flow and the willingness to put that cash flow into their investors' pockets provides a wonderful cushion against market volatility and is ultimately what helps to push share prices higher over time. The second commandment that we'll look at today comes from Michael Mauboussin. Mauboussin was the author of a 2006 book called More Than You Know, Finding Financial Wisdom in Unconventional Places. And he theorizes that the investment profession is about managing portfolios to maximize long-term returns, while the investment business is about generating often short-term earnings as investment return. This comes back to the old principle that's what's good for the advisor isn't necessarily good for investors. And it's really quite a shame in the financial business that so many people approach it as if they're creating product to sell to people, as opposed to providing advice to investors that will help them meet their long-term goals. Are the interests of the advisor or the manager aligned with the interests of the investor? Because really that's the only way that you're likely to achieve long-run success, is if it's in the interest of both parties to create that over time. The other thing that's incredibly important, I think, is full disclosure, and that fees that you're paying are upfront and disclosed, and really only in that way can an investor make an informed decision about whether they're receiving value for the fees that they're paying. The third commandment of investing that we'll talk about today comes from Warren Buffett, who everybody knows is the chairman of Berkshire Hathaway and the sage of Omaha, and probably one of the most successful value investors of all time. Buffett says that for a know-nothing investor, a low-cost index fund will beat professionally managed money. What I think Buffett is really talking about is cutting through the hype, and in the event that an investor cannot perceive value offered by the strategy and the advice of a professional manager, that they should really think about the lower cost option of an index fund and getting the same kind of exposure and fully understanding what they're paying for. In the professional arena, strategy has to resonate and fees have to be perceived as appropriate by the investor, or there's really no reason that they should proceed with that strategy. And I think that again means it's very incumbent on the investor to understand exactly what is being proposed to them. If an investor can't cut through the hype and can't make an informed decision on those principles, I think Buffett's notion is absolutely accurate, that exposure to the markets is attainable through what is a very low-cost alternative to professionally managed money, and that's through an index fund or an exchange-traded fund. In my next installment of Toron Investment Insights, I'll wrap up Rob Carrick's top 10 commandments of the investing world with the final 4.